Good Tuesday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. I'm coming in hot today. I had a lot of caffeine. So if you're in that easy peasy holiday mindset, it's time to get out of it. Get out of it now. Here are my 5 things that you need to know today. 1, gold prices have hit another record and are up a sparkly 70% this year. Gold has seen 50 record highs this year. 2, copper prices have also hit another record. Copper is up 30% this year. Sure is lots of copper being used in those AI data centers for show. 3, shares of the movie theater chain AMC are tracking to close lower for the 7th straight session. Focus appears to be on the company's debt pile and the potential to sell more shares of common stock. 4, gas prices have hit a 4-year low average nationwide ahead of the holiday travel rush. According to new data from AAA, the outfit says it's shaping up to be the cheapest December for drivers filling up their tanks going back to the pandemic year of 2020. Lastly, the holiday shopping season appears to be going decently despite affordability concerns. Preliminary data out today from Visa shows that overall U.S. holiday retail spending increased 4.2% year over year across all payment types, including cash and check. Lots going on today, not just the holidays. Here in the Opening Bid Roundtable, Stephanie Guild, Robinhood Chief Investment Officer, and Mark Palmer, Benchmark Company Managing Director and Senior Research Analyst of Fintech and Digital Assets. Good to see you both. Stephanie, let me start with you out of the block because I think the market's trying to figure out what to make of this GDP print, up 4.3%. Market doesn't seem to like it.
Yeah, I think we're in a good news is almost bad news because the market has also been really counting on continued rate cuts. And I think if you have such a strong GDP, it just leads one to believe that growth is really strong and you may not need the rate cuts. I actually still think we'll get one more and then the Fed will pause for a while. But, I just think the growth obviously means that, rate cuts are not really on the horizon, and that's going to be a bad thing for stimulus, that may help the market.
Mark, good to see you as well. Thanks for hopping on the show here this morning. So when you are thinking about your fintech names, how does the outlook for rates next year factor into it?
Well, fintech is impacted by rates pretty much across the board, especially those names that have any sort of credit element, of course. From our perspective, the market has, to a large extent, already baked in an expectation that rates are going to be at least modestly lower. So it really comes back to the more idiosyncratic factors impacting these names. Right now, what's front and center is consumer spending, especially around the holiday season. As we have heard, has been, for the most part, supportive. But we are seeing fintech valuations still at levels that are reflecting a pretty negative scenario. And that's where we see some opportunities simply because we just don't think that things are as bad as those valuations would reflect.
Mark, have these stocks been forgotten a bit? All year long, we're talking about 7 big cap tech stocks. That's the Mag 7. And a lot of these fintech names, as you know, they're very highly innovative companies, and the earnings growth has been pretty good.
It has been, but again, I think there's been, quite a bit of focus on the potential for there to be a significant pullback in consumer spending, the potential for the market to stagnate, and that's really been reflected in a lot of these names. Now, in some cases, we think that that's well-deserved. There are some business models out there, Block and PayPal being a couple of examples, that look a bit long in the tooth in terms of their ability to deliver on the promise that they originally had. These are names that are now becoming more mature in the later stages of their corporate life cycle. So we spend a lot more time looking at those other models that are a bit more impactful in the here and now. One example is Dave. Dave is a neobank that is providing short-term loans to those who are struggling to meet their expenses from paycheck to paycheck, which is an extraordinary number of Americans. The company has estimated that is north of 100 million. Now, the company has been able to put up remarkable metrics over the last several quarters, which reflects not only the fact that they have created what we view as a superior business model, but the fact that there's a tremendous fit with this need that is pervasive throughout U.S. society. So that's what we're really looking for is the promise of fintech, which is to use technology to better address the financial needs of consumers and businesses, being met. Dave is a good example of where it is.
Stephanie, let me get over to you. And I want to continue this thread from when I was hosting the 9 a.m. hour just moments ago. 7 stocks, Mag 7, pretty good year by and large, except Meta. The stock's gone up, but not that much as the rest of the names. Sentiment on some of these software plays, I call it out like a Salesforce. It's still negative. Do you see that turning? Do these turn into value names out of the block next year?
We think so. And that's kind of one of our bets going into next year. When I looked across like S&P, I was coming up with my sort of target. I was looking at earnings growth expectations, and they're obviously always have been historically driven by Mag 7 and those largest tech companies. And while I still think they'll have a strong growth year, I think it's hard for them not to. I took down my expectations relative to what the market is pricing in. Market's pricing in tech and the S&P at 23%. I moved it down to 18 as I was coming up with my targets. And one of the reasons for that is because, those largest names take up so much of the market cap that I think some of the better growth stories will finally be some of those software names like Salesforce, maybe like Intuit. I'm not necessarily into Adobe yet, but I do think that there is a place for them to start getting some of the real benefits from AI, and the market at least starting to discount in that they will benefit from the AI revolution because they do have a lot of the data and they have the customers in order to help them.
Stephanie, if folks are going to nibble at software after a tough year for these names this year, will it come at the expense of Mag 7?
I think a little bit. I still see a positive return from some of the Mag 7 names, but I feel like I've been saying this for a year, but like there's more to life than the Mag 7. And I think you want to treat each of the companies in the Mag 7 on their own. Like, would you invest in them on their own and not necessarily because they're part of the phrase? And so that's the way we're thinking about it this year too. So we own some of the Mag 7 in our portfolio for Robinhood Strategies, but we don't own all of them as a result.
Mark, let me get back to you on AI. I had my friend at the gym ask me yesterday if we are in an AI bubble. And the only thing I replied to them, go pull up the ticker symbol of HUD 8. I know it's a company you cover. I just talked to CEO Asher Granute last week. This is a company signed a big deal for AI infrastructure. The deal's backstopped by Google. I look at a company like that. I look at their pipeline. I think AI bubble. What are you, crazy? I mean, not at all.
I just don't see that you can justify there being a bubble at a time when the economics for the suppliers of power that are for AI's growth through AI data center plants continue to improve. HUD 8 just put together what is a phenomenal deal with Anthropic, with FluidStack and backstop by Google. It's got committed project financing from Goldman Sachs and JP Morgan, and the economics are outstanding. The company not only was able to get a backstop from Google, an investment grade company, but was also able to get it without having to issue any equity or warrants and dilute itself. So you wouldn't see a deal of that type with those sorts of terms if we were really in a bubble and there wasn't that level of demand. That's really what we are looking at, is the supply demand imbalance on the energy side, the energy infrastructure front. Is there enough energy to be able to power all of these projects, all of the large language model training, all of the other project development that's going on for the next several years? And what we see is that certainly by 2030, the imbalance is going to become very apparent. And companies like HUD 8 that own the power assets are going to be very much advantaged.
Before I let you both go, I'm asking everybody this week, surprises, all about surprises. Stephanie, is there something that has surprised you in markets this year?
I think for me, I'm surprised by we're not seeing as much inflation in the data, at least, than I expected just from tariffs. Like, I thought there would be sort of naturally a little more inflation that would then dissipate and be transitory. And so I'm like wondering if that's will eventually show up, or if it's just not something that anyone should have ever worried about.
Mark, same question for you.
Yeah, I think to a large extent, I had expected that we would see faster development of some of the blockchain and crypto initiatives that are out there, just given their promise and the fact that they have the ability to revolutionize certain areas of not only commerce but society. But I think that part of that is because I had expected that we would already see legislative changes that would enable some of that progress to occur. So as we pivot to 2026, very much focused on the market structure bill that is pertaining to crypto, that's getting ready for markup in the U.S. Senate. We think that that will set the tone for 2026 in the digital asset space.
Two of my faves making time for the opening bid roundtable today. Thank you both. Happy holidays. I will talk to you soon. Appreciate it.
Thanks, Brian.
All right, straight ahead, why I'm taking another look at Ford before the end of the year and what I learned from Ford CEO Jim Farley on a trip to Detroit this year. We'll be right back. Following breaking news, ServiceNow will acquire cybersecurity startup Armis in a $7.75 billion deal. You're looking at shares of ServiceNow under pressure a little bit on this news. Armis specializes in identifying and tracking security threats on devices. The acquisition is part of the company's plan to expand its cybersecurity offerings amid the AI boom. ServiceNow expects to finance the transaction through a combination of cash and debt. The deal is expected to close in the second half of next year and marks the company's latest acquisition to date, or largest acquisition to date, I should say. All right, I am genuinely fascinated by the year Ford has had. On the one hand, the stock is up 36% year to date, despite earnings not blowing the tires off street expectations. Meanwhile, Ford just took a $19.5 billion charge tied to its EV plans. The EV business simply didn't pan out like Ford expected, and now it's hitting reverse on its investments here. I spoke to Ford CEO Jim Farley at the automaker's Pro Accelerate conference in Detroit in September, and he addressed EV demand and the state of manufacturing in the U.S.
Factory workers, construction workers, farmers, all the people that move things, truck drivers, rail workers, and people fix things. Plumbers, electricians, HVAC, all the people that basically work for our hands. Think with their hands. Think of like Mike Rowe, all of Mike Rowe's friends.
I love Mike Rowe.
Yeah.
Why is there a shortage of these workers?
Well, it's a complicated problem, but there is, let's put it that way, literally 1 million people openings right now. Technicians in dealerships working on cars. At Ford, we have 6,000, probably 400,000 repair technician shortages across the economy. I think it's a couple things. First of all, the productivity has not caught up with the white collar. In fact, it's gone down over the last 20 years. Number two, the jobs aren't as glamorous as a white collar job from college, which is kind of the primary path that our whole economy, investment was for new jobs. And I think the permitting and all the regulations has really stunted the growth of these kind of jobs. The one that I focus about the most is kind of the society's view of these kind of jobs. When a plumber, electrician comes to your apartment or your business or to your house, how do you treat them? Do you treat it because these people are running our communities. And so many people take them for granted.
You're the only CEO, from what I can tell in the past year, that is out here holding a summit like this, trying to get new skills into the next generation of humans. Why aren't more CEOs focused on real world applications like this?
I think it's because maybe it's more acute for a company like Ford. Look, the president has policies for us to grow. We make 80% of our vehicles in the US. We're the largest automotive company in terms of manufacturing and exporting. And so we have the shortage of mechanics. This morning when I woke up, there were 6,000 bays in our dealerships with no technicians.
So can't get my car fixed?
Nope. 2 weeks. Average wait is 2 weeks. Not because we don't have the parts, we don't have the mechanics. Same when we went through the strike and the UAW worker, we had a 2-tier wage. Most of our entry workers in our factories working 3 jobs. We solved that with the new contract. They get full wages, but we still have that stigma of working in a factory. So I saw these problems firsthand at Ford. When I talk to my pro customers, they're all small mom and pop plumbers, electricians, HVAC that go into New York City and fix the elevators and the AC when it goes out. Those small companies don't have a next generation coming up. They're all worried, what are they going to do with the shortfall of skilled trades in this country? I guess we saw it first at Ford, and we're also a kind of company that doesn't like observing problems. We like fixing them.
What's the blunt reality if we can't get this fixed? Inflation,
delays. Right now, it's 10 years to build a bridge in our country. It'll be 20. You want all these data centers built? You got to be waiting, and it's going to cost a lot more than it should. And probably the bigger is the social cost of all these million jobs that could be great contributors to our economy that won't unless we do something. That's probably the biggest cost. When I'm 62 years old, I think more and more about that person, that million, one of those million people, how their life could be changed if they can be a mechanic at a Ford dealership, but they just don't know how to get from here to there.
President Trump has focused a lot on bringing back manufacturing to the U.S. Now, on paper, this sounds absolutely amazing.
Yes.
Well, what if we see that spike in demand and we don't have the workers to satisfy this?
Well, that's what's going to happen. That is what is happening right now. It'll be inflation. It'll be these projects take twice as long. I was talking to a construction CEO today, and he said, hey, this is a $4 billion, now it's going to be a $5 billion program. I just know, Jim, because I can't find, so I got to steal people, and I have to pay more, which is great to some extent. But that million gap is not going away. It's getting worse. I love the president's policies, but if we don't backfill it with real programs, that's what we're trying to do here today, real progress, we are just going to pay more and get more and more frustrated.
What are the programs you're putting in place to address this?
Well, we have apprentice programs. We're starting to work with charity companies to spin up trade schools. We need to do a lot more on permitting, so the company has to go in, not at the national level, local and state level. We have a lot of progress to make there, and we need to invest as a company in productivity for our essential workers. I want my factory workers to catch up and pass my white-collar workers in productivity. That means we got to give them AI tools, and that's going to cost more, but it's the right thing to do. But not all companies have the resources Ford does. If you're a small mom-and-pop company of electricians, you do not have the resources of Ford Motor Company. I'm not worried about Ford. We'll do the right thing. I can't wait to tell everyone what we're doing. But what keeps me up at night is all those companies that don't have the resources we do.
Why I love your earnings call, Jim, is because you keep it real. And you kept it real with this number. $2 billion net tariff impact this year. How does that make you feel as a CEO of a company like Ford?
I mean, it's frustrating because we're the most American auto company and we export the most, and yet we have this $2 billion headwind, which prevents me from investing even more in the U.S. So it's frustrating, but I got to tell you, we've had some really good conversations with the Trump administration. I know they feel our pain. I know they want to help us with this problem. What I've seen them do on the EPA side, really put the EPA tailpipe emissions more in line with customer real demand, that gives me hope that we're going to find a solution for that $2 billion parts bill.
Is the pain most acute in auto parts?
Yes, that's where it is. Basically, the tariffs should theoretically help Ford, whether it's bilateral from Japan or South Korea or Mexico or Canada. Our competitors make a lot of their trucks outside the U.S. I don't. I make 100% here. Theoretically, that's higher cost for them. The reality is, if you want to make it in the U.S., I have to import literally thousands of dollars of parts on F-150, the best-selling car in America, to make it affordable for people. It's already $700 a month. I don't want it to be $800. So that wiring loom or those fasteners that we don't even make in our country, I have to import. But I'm paying 25 to 70% tariff on those imported parts. It adds up to $2 billion. So that's what we're asking the administration for. Hey, help us make more in the U.S. by making these tariffs on the parts for cars more reasonable.
Last one before I let you go, Jim. You made a very powerful statement on stage, and I followed your whole EV journey. You said customers are not interested in $75,000 EVs.
Yes.
Is the reality that the EV market's just going to be smaller than people thought.
Yes, and I think we learn. I mean, it's anytime there's new technology. What if your Motorola and Apple comes along with the iPhone? You know, things changed when technology moves through an industry like electrification or software-defined vehicles are also changing our industry. We've learned. We've been number 2 to Tesla for 3 years, and we learned that people are not willing to pay $30,000 premium for that big battery on a $50,000, $60,000 utility. But they're willing to buy a $30,000 EV if they save $2,000 a year compared to gas costs. So the issue is we had to reload our capital on what we learned, move as fast as we can, and then we got to make sure we're future-proof to BYD. They have full support from the Chinese government. You know, they've been at this for 20 years. They have a lot of good IP. Ford has to innovate to catch up with BYD because we're a global company. We're going to compete with them around the world. Electrification is not slowing down in China. It's not slowing down in the rest of the world. Maybe here in the US it is, but not the rest of the world. That's why we developed this innovative universal electric vehicle platform that's $30,000 affordable EV.
That does it for opening bid this morning. Tomorrow we'll have to see if Santa Claus brings his annual rally to the market. But for now, my gift to you is this picture of friend of the show, Kenny Polcari, and his sleigh. This comes compliments his newsletter this morning. Love that photo Kenny put out there. Try the cookies and milk. That's for the real Trader Talk fans out there. But first, up next, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves of the trading day. We'll be right back.